Okay, we'll go ahead and get started with just a couple preliminaries. First of all, just to make sure you're in the right place, this is Trust Funds ABC to Z. I know there's 5 or 6 other things going on, so make sure you're in the right one. Also, there are handouts here and on the table at the back. If you did not get one when you came in, please make sure you have one because we will be using those instead of slides through part of the presentation. So we're going to go ahead and get started. Trust Funds ABC to Z. When I first started at the university, I worked in accounting services, and prior to that, I worked as a systems trainer for the finance systems at UNC. And trust funds were what I worked with more often than state funds. And so when the opportunity came to do this session, I agreed to do the session. So we have someone taking notes. If you ask questions I can't answer, we'll get the answers for you later. But hopefully we'll be able to talk and find out most of the answers for what you need. Whoops, too fast. Okay, so this is going to be a high-level overview of trust funds, and then there's going to be some resources that you can use when you go back to your office later, as well as the handouts that you have that I think will give you a pretty good understanding of trust funds, where they come from, how they're managed, and how they work. Our agenda today is, what are trust funds? Do I use cash, budget, or both? Special trust fund budget terminology, tips and tricks, resources, and then questions and time for discussion at the end. And I plan to wrap this up in less than the time allotted, but we do have time for questions and review if you have them, so don't be afraid to ask. So before the session, in the little overview, I sent out the question, how many types of trust funds are there? Who wants to take a guess? There's Candy. Who's guessing? 12? Anybody else guessing? 30? 5, 12, 9, 7. I see somebody here from sports exercise, and here I am handing out candy. This is not good. So today, hopefully we'll find the answer to that question. How many? 12. That's a good guess. 10. You want that one instead? Okay. Everybody can have candy before you go. You want M&Ms, Bing? I know, right? It's participation, an award for participation. So hopefully today we'll be able to answer that question, or you'll be able to answer that question, although I guarantee that no matter how many there are, you're not going to use them all. So what is a trust fund? So a trust fund is defined by the state of North Carolina General State Statute. The statute number is 116-36.1. This is your first handout. If you'll take a look at that, you'll see those of you that guessed 12, there are 12 defined trust funds on that sheet, but there really are more categories at our university than just those 12. So 12 was right, but there are more. So basically, what I was told when I came here, and I think it's a very true statement, we have state funds, and then we have non-state funds at the university. And anything that's a non-state fund is considered a trust fund by and large, okay? So with state funds, you, as a department outside of the central offices, you typically only receive your budget. You don't own the cash. It's not guaranteed that you're going to get that money every year. You use it or lose it kind of philosophy. If you don't use it and you don't have a justification for keeping it, then it may not come back to you next year. And you have restricted spending on the state funds. Trust funds are very different than that because trust funds all operate basically the same. Most of the time, they're cash accounts. They're not given to us by the state legislature like state funds are. So there's some very distinct differences between state and trust funds. The way that state funds are given to us, it comes from the state to the GA system to UNC down to the schools, the departments, and then down to the division and departments within those schools and units on campus. And there's a lot of decision makers along the way. Every one of those little places has a decision to make. And then we have someone here from the provost office. They make some decisions on state funds that get sent out for certain things as well as the central offices. With trust funds, it's typically not like that. Typically, the decisions on trust funds and the ownership of trust funds resides with the school or the unit on campus. So that's very different. Just for the record, I will mention that trust funds also includes OSR and FNA funds, although in the day-to-day operations, OSR and FNA funds operate very differently than most trust funds do. FNA operates more like a state fund, and OSR is guided by a different set of rules and regulations by either the group making the grant or by the rules and regulations set forth in the legislature for those types of funds. So they, even though they're technically trust funds, they operate very differently. So what is a trust fund? How is it governed? What does it look like? If you look at your second document that I handed out, so a trust fund is governed by a defining document, and this depends on the type of trust fund as to which document it is, and we'll talk more about those in just a minute. One that most people are familiar with are gifts. Gifts are governed by the donor document. If the donor gives us money, they give it to us for a specific purpose. Maybe it's for athletics, maybe it's for internships or scholarships or a professorship, or they could say they're just going to give it to your particular area for your dean or your manager to determine how to spend it for the operations of your unit. It could be a contract, it could be a grant that does not go through OSR. We have contracts sometimes with other agencies to provide work for them, or they're providing work for us. Those would be contract trusts. Same with some of the grants. We get grants from foundations that do not go through OSR necessarily. They're few and far between, but there are some out there. Most of our grants will go through OSR, and they have to follow the same rules and regulations that this federal and state grants do as well. And sometimes we have sales agreements. If you have auxiliary funds, you may be in an area that does a lot of sales. For example, bookstore. If you had a bookstore in your area, you may sell different things and take in money from the books that you sell. I'm at the School of Media and Journalism, and we had a professor who wrote a book, and people were coming to him asking for training and to do different things related to his book, and he was selling the book, and that was a sales that we took in for that. So the source authority that you have is your second document. Once you get the agreement that tells you what kind of a trust fund it is and how the money is coming into the university, that donor document becomes a legal part of the documents for that particular fund. Or it could be the contract or whatever document it is. This document that you have in your hand is called the source authority. It used to be called the fund authority in the old days. And what this is telling you is just basic information about the type of fund that you have. And you can see on the paper, if you've ever created a source create in Connect Carolina, it follows the same questions that they ask you. They want to know, where did the money come from? How are you supposed to use the money? Are there any special terms, any special instructions? And at the top, you'll notice it tells you that it's a trust fund, and it also lists that state statute that we looked at a little while ago that's required to be on all of our source authorities. And then if you look down, it asks you for the name of the source, whatever the name is going to be, the Joe Smith Trust Fund or the, Janie Smith Internship Fund or whatever it is. And then dispersed on the authority of. This is a required little paragraph that's going to be on all the source authorities. It's required by the state legislature and UNC. This is signed by the Controller's Office. This is a legally binding document that goes with the underlying supporting document that tells you about what kind of trust fund you have. There's also, while we're here talking about these, if you ever want to look up a document for one of your trust funds, you can do so in Connect Carolina. When you go into Connect Carolina and you go to your main menu and then your finance, what is it called? Finance something? Finance menu. And then go down into your finance menu and you go to the UNC campus where you do your journal entries and vouchers and that kind of thing, or journal entries up there. There's a space that says I think it says fund source lookup or FRS lookup or something like that. So you can punch in either the old FRS number that was before Connect Carolina, or you can punch in your source number for the Connect Carolina, and it will pull up the documentation that's out there that was attached at that time. They do not have that open for foundation sources yet, but trust funds, most of those are in there. I will say this too, when you go to do that, a lot of our really old trust funds did not have a donor document or may not have had a fund or source authority at that time. You can check with accounting services. Sometimes they have one in their files that didn't get out to campus. But a lot of times back in those days, campus set them up and didn't tell accounting services. And so even though the number was in the system and they were using it, there was no documentation on file. And sometimes you'll find some of those older ones, it was just a letter from me to my friend who's the dean saying, gee, I just want to give you some money. Here it is. Use it for your library. Thanks. Love, Joe. And it was that simple. And they created it and set it up. So. I just want to make sure I mentioned these. Yep. One more thing I want to say about source authorities. So source authorities can be amended or they can have an addendum on them, and they're two different things. So if a source authority is out there and it says this can only be used for a scholarship for blonde-haired, blue-eyed people from Cumberland County, and you don't have any of those, and you want to change that, then you have to go back to your underlying document, get that donor or that person to agree to change it, and then you can go in and change it and maybe say everybody in North Carolina or make some other restriction on it. But it has to be approved through accounting services, through the appropriate channels. You can't just make that change on your own. It has to be approved and has to be signed. The underlying document would have to be re-signed. Same if it was a contract, a grant, or had an MOU, a memorandum of understanding with another unit or another group, internal or external, you would have to get that redone before you could redo the source create. And you can do those in the source create module in Connect Carolina. There's an option in there to do a change to one that's existing in Connect Carolina. And so just remember, you have to get the underlying document approved before you can make that change. An addendum is a little bit different. So an addendum is something that you see a lot with donor agreements when they give you money. So they may give you money and say, I want to give you $100,000 for a scholarship. And it goes on, time goes by, and then they come back to you and say, I've been thinking about it, and I think I want to give a scholarship, but only to the people that are in this particular program at your school. Or maybe they want to change it and say, I've decided I want this scholarship to be out there, but only give it out every 2 years instead of every year. Maybe their endowment's not making enough money or whatever. Those can be done as addendums because they're not changing the basic purpose of the original document. It's still a scholarship. They're just adding an addendum to say, we're now going to be more specific, less specific, or they're going to keep that same purpose, but they're just changing something about it. And that can be done as an addendum, and that needs a signature as well, but it won't change your fund authority because it will still be that same purpose. Mm-hmm. That's a good question. She asked, what if your donor has died? How do you make a change? You can go through university development for all gift funds that are sponsored, that are given by a donor, and they will try to find the next of kin. And just as kind of an aside to this, but in Davie is a system owned by University Development. And in Davie, they track the donor, donor's interest, donor's gifts, donor's association with the school, how many events they attend. They track their relatives, anybody else that's related that gives money. And so they have ways to go back and see who their next of kin is. And they will go back and say, your mom gave this money, but she's passed away, and we're thinking we could better use it this way. What would your family like to do? And we just recently did that in our school with one. And the daughter said, Mom gave that money because she really liked this program that you did. And so I'd like to give you more money to go with that, and we'll put it for that program. And it worked out great. And the family likes to know that their loved one was remembered. And so if there's not a loved one in the picture, then university development has a process by which you can make the change, but it does jump through a lot of hoops. You have to go, I think, as the Board of Trustees has to approve it and that kind of thing. But they will help walk you through those steps as you get ready to do that. So how many types of trust funds? So if you look at your third handout, this one is probably familiar to you. This was one you probably saw when you did your initial Connect Carolina training, or if you've been in the system for a while, maybe you still use it as a hand. I was talking to Amy a while ago, and she said, you know, I still use this document a lot, and I do too. And I think it's a good tool to kind of keep in front of you. So if you look at the top of your page under the blue line that says Fund and Fund Description, you'll see the first group up there is state funds. So if you notice, they're all up in one group at the top together, so ignore those for this session. This session's talking about trust funds. So you start where it says Contracts and Grants, OSR. And this document tells you on the left-hand side in the big block what the fund is going to be. And on the right-hand side in the middle, well, the right-hand side tells you where the source description is, and then in the middle it gives you the source number. So this is a quick way to identify what kind of fund you're looking at. If you're looking at a transaction in Connect Carolina, maybe one that someone else in your unit processed and you didn't know what it was, you could look here and say, oh, it starts with 252, it's a contract and grant, and it's a 494, that means it's an NC state government grant. Then overhead is the next one, that's F&A. That has two, the 14101 and 102 and 103 together. This is also the source where you're going to find any items that have gone into suspense from your payroll that did not have appropriate funding or an appropriate chart field. Your suspense items will be, I believe it's in 14103. Auxiliary and others. These are also called proprietary funds if you're into governmental accounting. And those run in two different ranges. So the first one is for auxiliary trust services and student auxiliaries. And these are things like some of our student groups have one in here. Auxiliary trusts, or anytime you're bringing in money external from, typically from like a sale or something like that, sales and receipts would go there. Your 194 to 199 are your recharge centers, your core facilities, your auxiliary trust, departmental, and interdepartmental service. So for example, if you work in chemistry and you are selling beakers or glass or something to another unit on campus, you would be in that 194 to 1999 level with your accounts. Recharge, those are typically, you'll see most of those in the medical area, health affairs. They do a lot of recharge. If they're doing like a mass spectrometer or something like that for another unit on campus or external, they'll use one of these funds. Athletics, very specific to athletics. Is there anybody in here from athletics, by the way? No, okay. UNC faculty practice, anyone from faculty practice in here? Okay, a couple of you. So you will notice that these all have very distinct, where the other funds had a range, 27,100 to 27,1XX. These are very specific. Athletics 28507, UNC faculty practice 28542. And then you'll notice your range, you have one, and that's for your clinics, admin, and hospital contracts, all go in that same one. And then you will separate those out using program and cost codes or some other mechanism in your EPIC system that draws those out. Same with dental faculty practice, very specific fund. Capital improvements. These are very specific funds. Not everybody has them. Our particular school doesn't have them, and therefore large improvements that you're doing to your infrastructure of your building or your area. If you have one of them, you'll work very closely with our facility services folks and design folks over in Anna Wu's area. If you go to the back page, endowment income unrestricted, and then you'll see endowment income restricted. And then you'll see something called endowment funds principle. How many of you work with endowment funds? A great number of you, okay. So what I'm going to say next, you'll probably be bored, so take a nap. So endowment funds are when a donor gives money to the university or to a school or department, and they want that money invested for the long term, and the income off that investment can then be used and be spent for the purpose that the donor intended. So let me give you an example. Let's go back to a scholarship. Let's say I want to give a scholarship to your unit, and I give you $100,000 for the scholarship, or maybe $1 million, and maybe I'm really rich, $1 million for the scholarship. That money is going to be invested through our UNC Management Company, and that money is put on the stock market, and they have a set way that they invest that's been approved by their board of directors. And then every, well, it used to be every year. They're actually showing it on your statements now, I think every month. But every year, let's say, they will do an annual payout on those funds for the income that's earned. The endowment principal, the original money that I gave, will stay in the endowment in perpetuity. You cannot use it. You cannot take it out of there. It stays in there in perpetuity. The income is what can be spent, and that gets moved to a separate income account. And that's why there's two. So when you have an endowment, you'll see if it's restricted, it'll be 282 whatever, and it will be, let's say, in the 70,000 range. Then you will have your income, which will be 282 if it's restricted, 281 if it's not, and it will also be in the 70,000 range with the same number that the principal has. So when you're working with these trust funds, you have to be very careful and make sure that you check the fund, because that will tell you if it's restricted or unrestricted, and it will also tell you whether you're talking about principal or income. And so even though it's the same fund, same donor, same money, one is the principal and one is the income. Any questions about endowments? Adding to them, good question. So in most trust funds, when you receive money from the donor or from others, most of the time the fund authority will say, so-and-so gives this money, and in addition to any other gifts that may be given, can be put in here as well. When you're dealing with an endowment, all new money coming in has to go into the principal. So if I gave you the $1 million and it's been in there 4 or 5 years, and I come back and say, I want to give you $50,000 to boost your program, I can't just give it to you in this endowment income. I have to give it to you in the principal, which means you don't get the benefit of that $50,000 directly. You get the benefit of the income off the $50,000. Make sense? There is another way for them to give you money, and we can talk about that in a minute, that's not endowed, but the endowments are very strictly governed. And so there should never be true revenue coming into an endowment income source. Yes, ma'am? Okay. Okay. Good question. So in case you didn't hear the question, in 2008, 2009, the market took a dive, and our investments took a dive right along with it. No surprise there. And she's asking, what did that mean? What happened to the income that was generated? Did it have to go back into the principal? So with the income, just as a general statement, you can either spend the income for the purpose intended, or you can choose to reinvest it back into the principal. Now, if you do, there's probably more than you need to know, but if you do reinvest it back into the principal, then that amount, that reinvested income, can be pulled out and used later without a problem. Now, I told you earlier, your principal can't be touched, and it still can't. But the reinvested income, which acts like principal, can be pulled out. But while it is in the principal account, it does earn income. So if you pull it back out, it's going to reduce your payout. Okay, just to be aware of that. Now, her question about underwater, what does underwater mean? So when the donor gives you $1 million and it's out there in the stock market, and the stock market's doing great, it's earning money. But when the stock market may tank, that value of that investment that donor gave you may drop below the $1 million. So it may drop down to $900,000. That's called being underwater. So if you hear him talking about an endowment that's underwater, it means the value, fair market value of that invested amount has dropped below the original donor value that they gave. And you'll see this from time to time on certain endowments that were out there. And so when that happens, when that goes underwater, there's something called the UPMIFA Act, UPMIFA. And that's the Universal Prudent Man Investment Fund Act. Thank you. I was trying to remember all the acronyms. Act. And what that says is that while that endowment is underwater, you will be required to put a portion or all of the income back into the principal to raise it back up to donor value. And we're trying to protect the donor's value in that, in that endowment. And we also want to protect our future in that endowment, being able to, get the payout that we need for the purposes that we intend it for. So that's what it means when it says underwater. And if you see the MIFA Act, that's what that means. You have to put the money back, a portion of it. Yes. So she asked, who puts the money in, the donor or the institution? So the income is given to the institution, to whoever, whatever your unit is, and it's our responsibility in the finance area to put the money back into the principal. If it's the UPMIFA, where if the endowment goes underwater, and we are required to put a certain percentage or all of that income back in, then that's the university's responsibility to make sure it gets back in the principal. No, that's a good point. Donor does not have to put additional funds in to bring it back up to original donor value. It's our job at the university to make sure the income gets put back in. And we would put it in every period that it was still underwater. Now, there are occasions when the donor knows it's underwater and they say, I want to put more money in because I want you to get a certain dollar value payout. And so donors can do that, but typically that's not, we don't do that. And it turns out that we don't have long periods of recession where the donor value keeps dropping and dropping and dropping. It's dropped maybe a year or two, and then it's bounced back and come back up. And right now in our foundation, in our school, we don't have any that are underwater because the market's been on a real high. If it starts to go down, there's a few that we'll start looking at and just kind of watch. There's a report called the UAS report, and that's in Connect, Carolina. If you haven't seen that yet, you'll want to pull it up and look at it. That tells you your donor value. It tells you the fair market value, tells you the anticipated payout, tells you how many shares are in the market, gives you all kinds of good information. So you can pull that up and look at that. Amy? Mm-hmm. Good question. That is correct. So her comment was, when the market does recover and you've already put all this income back in, can you take it out again? And the answer is yes, you can. Once that donor value gets back to where it was or above, you can take out that reinvested income out of the principal. So, yes, ma'am? Do you have to account for the income earned of the income reinvested? Okay, her question was, you have to account for the income earned on the income that was reinvested separately, and the answer is no, you do not. Once that income is reinvested in the principal, we track it separately. On that UAS report I just mentioned, it will track it separately, but the income payout will be in a lump sum, and it's based on the entire principal, which includes the original and the reinvested income. Ellen? Correct. So what Ellen is saying is, if you have a fairly new endowment and it's not earning a lot of money, you can choose to put that income back in until it builds up to a sufficient value for you to use it. And that's called a timing restriction on an endowment. And sometimes donors will tell you that. They'll say, I want to give you $1 million, but I'm only going to give you $500,000 right now to set the endowment up. I'll give you the other $5,000 between now and 10 years from now. So until I get the whole thing given to you, I want you to just keep reinvesting my income and build it up. And that's called a timing restriction, and that is allowed. And it's also allowed, if there's not a donor timed restriction, that different units can choose to reinvest that money so it builds up. Because, if you're giving a scholarship, $500 isn't going to do much. You may want to put it back in until it builds up so that there's a payout of $5,000. Or the other option is you can hold it in that income until enough period has gone by that $500 each year for 5 years, you'd have $2,500 to give out. So there's options on that. The next type of fund to talk about are the trust unrestricted funds. So these are in the 291 fund type, and there's 3 different types here, 4 different types actually. How many of you have impressed checking accounts? Okay, we're not going to talk in depth about impressed checking accounts, but they are listed in this category. Petty cash, some departments have a petty cash fund. They are in this area. They start with a 1. The skip up to the $15,000 and $15,999. These are unrestricted expendable gifts, devises, or bequests. So if you get a bequest from an estate, you have a gift, someone gives you just an anonymous donation, it would go in your unrestricted gift fund, and it would go in this source range. When you see the A and the X, we're going to talk about those in just a minute, so skip that for just a second. Then you have your trust restricted funds, and these are, again, those contract trust non-OSR, the restricted gifts, devise, and bequest, which you'll see the most of, and the A to X again, and we'll talk about those in a minute. So if you have a source that starts with a 5, this is where it's coming from. It's a restricted trust fund, and the restriction comes from the underlying document. The donor, it comes from the contract, it comes from whatever document was underlying the creation of that source. And then education and self-supporting. These are in the 241 range of funding and the 1416 range of sources. So the 142 to 1499, student fees, clearing department, and BOG directive. So if some of you recall, I guess it's been 3 years ago now, correct me if I'm wrong, Gordon, but I think it's been 3 years since we had the BOG directive that some of our funds had to be moved into this 291 fund source, and I'm sorry, the 241 fund source in the 142 area. These would be things like if you're collecting student fees, they would go in this range. We have our student fee account that funds our IT department. It's an education and technology fee, and it says BOG on it because it had to have the Board of Governors approval to do it at that particular time for that one, so that's what those are. Residual funds. So residual funds is a place to put the money that's left when a contract or grant ends and there's money left over. This should never be a huge amount of money. If they're doing a contract or grant, that donor expects them to spend that money for the purpose that was intended in the agreement. So residuals aren't as big as they used to be. They're starting to crack down on those quite a bit. And most of the time now, the donors will say, you can keep up to 2% of the residual non-direct, or they'll tell you, you can keep up to $1,000 at the end of the grant left over. They won't let you just fudge the grant and then keep the money later. Because what happens in the grants, the monies are very restricted. When they move over to this 1/6 area of residuals, excuse me, they're not restricted anymore. So you see the benefit? If you have it in your grant, then suddenly you move it to residual, you can do whatever you want with it. So they're cracking down on that. So they don't allow too much of that anymore. And then the 165, 1699, conferences, workshops, seminars, etc. So this one is a little different too, because when you open your 165 account for a conference, workshop, or seminar, you can use that one fund source for all your conference and seminars that are in your area. And you can code them with your program and cost coding. The other thing is, if you have funding that's not coded, it's just general registration money that you had left at the end of your event and you leave it in here, you do have the option to use that for any future event, even if it's not the same type. Okay? So let's say you have AICPA come in and talk to all your accounting students about becoming a CPA. And everybody pays $50 to get in the door to hear the speaker, and you pay for your food and so forth, and you have $1,000 left. And then in another month, maybe you have a conference where they come in and talk to your faculty about diversity in the classroom. You can use that $1,000 to pay for the conference fees and expenses toward that diversity conference. You don't have to keep them separate. If you code them in there, you can keep them separate, but it's not required. You can use them for any conference or workshop that you have. The next group, loan funds, student loan funds, you'll see these in School of Nursing. Anybody here from School of Nursing? School of Nursing has certain loan funds. I think it's called a Perkins loan that they have that they manage through the schools. There are other student loan funds on campus. If you have these, accounting services can give you very specific instructions on how to work with them. Generally speaking, it's not something everybody would just have because they are for student loans. Foundation and other agency funds. So this is a good one. So agency funds, $29,900. So agency funds are any type of funding that we take in at the university that does not belong to us, it belongs to someone else, and we're going to pass it through to them, okay? An example of this is federal and state withholding out of your payroll. We collect it, we don't own it, and we send it out immediately to the federal or state revenue agency. That's an example. Another example that you might see is common. Let's say you charge a fee for the key to the lab rooms in your unit. And so every student that gets a key has to pay $25 to get that key. That's an agency fund. You don't own those funds. You can't spend those funds. It's a deposit. If they default and don't bring the key back, then that money is used to get another key. It's not money you can just, go out and spend, because if they do bring the key back, what are you going to do? You're going to give them their money back, right? That's why it's an agency fund, because technically it really doesn't belong to the university. So that's an agency fund. The next group is a really important group. So this is the foundation group. So the foundation, let me go back a second. So all these other trust funds are at the school. And you see there's so many different varieties and so many different little nuances even within those funds and sources. The foundations, though, are much simpler. They only have two kinds of funds. They have endowments or they have expendable. That's it. That's all they have. And so the foundation funds that are endowed work just the same way as the other endowments that we talked about. It's just that the foundations are a separate legal entity, and they legally own those funds. The school itself doesn't own them. But they're handled the very same way. They're actually, if they're part of our affiliated entities with campus, then they're deposited the same way, they're processed the same way, and they're invested the same way, and they receive the same type payout that the university does, which I'll just mention payout for just 1 second before we get off endowment. So when our funds are invested in through the UNC Management Company, through what they call CHIF, the UNC, let me see, what is it? The Chapel Hill Investment Fund is what CHIF stands for, and the UNC Management Company is the company that manages it. So our endowments in the past 2 years have had a 12%, and this year I think it was like 12.1% return on their investment. That's really significant. For those of you that know anything about stock market, that's a huge return. However, what's happened over time, these investments have gone up and they've gone down. And in the down years, people were struggling because if they had committed this money for a professorship, a scholarship, or for a salary, or for whatever reason, and the market went down and they weren't getting the payout, they were in trouble, because then they had to find other money to cover those expenses. So what the university has done with the management company, and if you're an affiliated entity foundation, you have agreed to this as well, they've agreed to give approximately 5.5% payout every year, regardless of the market. So in years like this, when we have 12, we're getting less than we earned, but what happens in the next couple of years when the market dives, we're still going to get our 5%. It's called income averaging, for those of you in accounting lingo. So income averaging helps you because you can budget that. You know you're going to get 5% of whatever that is. That UAS report will show you your anticipated payout so that you can be planning for your next year on what you have to spend. So back to foundation endowments, principal and income. So in this case, the principal and income have two separate funds. 29920 is always income, I'm sorry. 29910 is always principal. So whenever you make a deposit, it's going to go in which one? 29910, more candy. Who's answering? I don't know who answered. Whoops, I'm sorry, take another one. So 29910 is where your principal would go. Does somebody over here answer? You might as well take it. I have the whole bag. Somebody else answer? Okay. Have one? You're welcome. At least the candy keeps you awake a little bit, right? It's the last session of the day. I'm trying not to be too boring. And so the 29920 is where you're going to see all your expenses when you pull up your endowment income. Now, in the title, we talked about trust funds A, B, C to Z. Well, these are the Z's. So if you look back up under university trusts, you'll see there were some that said A 0000 to X 9999, unrestricted income allocations from the foundation. You'll see another one, restricted income allocations from the foundation, and then you'll see down here, the foundation endowments and the expendables all have A to X in their name. So your division, your unit, your school has been assigned a letter. I'm in the School of Media Journalism, our letter is J. So if I see a J and it starts with J0, XXXX, whatever it is, I know it's going to be one of my endowments. But if it starts with a J5, which is an expendable, it's going to be an expendable fund. The same way with you. Whatever your letter designation is for your unit, if it's that letter and a 5 right after it, you'll know it's an expendable fund. Okay? And those are always 29930. Expendable funds are just kind of like gift trust funds. They can be restricted or they can be unrestricted. It just means that the money is expected to be used up in a fairly short term. Typically, we expect it to be used up in 1 to 3 years. But if it's something that's a very popular fund, or maybe it's an unrestricted fund, you could be getting money all the time. And so it would always carry a balance, and you wouldn't be expected to spend it down, but you would have that option to spend it down, and when it's gone, it's gone. Where with the endowment income, you spend it down, you get some more back again next year. So that's the difference between the expendable and the endowments. The other thing I'll mention about foundation funds, for those of you that have them, the foundations were created to support the university, okay? So foundations can give the university money. So you may ask your foundation to give you money for a trip that your students are taking, or to help pay for some operational cost, pay for salaries, pay for anything like that, and they can give you the money. However, you cannot give money to the foundation because that is against our exempt purpose. We're a 501c3 at the university as well. And legislature has said that we cannot give, gift, or donate money to any organization, individual, or business. And that includes our own affiliated foundations or affiliated entities. We cannot give them money. Now, we may have a contract to pay somebody money. That's a different thing. I'm talking about just, let me give you $25 towards your cause. We can't do that. So when you're working with foundation and trust funds at the school, just remember you can go from foundation to school, but you can't go back again. So if you move the money over, it's at the school. Terry?
What's the difference, or how are these related to the 299 foundation account and then the 298
Up above.
Yeah, I'm trying to understand how this works. So when the donor gives us $1 million, is that a foundation endowment? That's what the foundation endowment.
Okay, so our question is, what is the 29800 up under university endowments versus the 29920 under foundation, or 29910, I'm sorry, under principal foundations? And when the donor gives us money, does it go to the foundation or the school? Good question. So the donor determines where the money goes, and your development people help them along with that selection. It depends on what the money's for and how it's going to be used. For example, our foundation does not have employees. Some of the foundations do. Ours doesn't. So we don't want to put anything in there that's going to pay an employee because we don't have them. And we're just going to have to do extra steps to move that money to the university to spend it. So we would guide people to give scholarships to our school, not to our foundation, or anything that's going to fund a salary to our school, not our foundation. And our development folks know that, and they can help guide that decision. Sometimes people have a decision. They may say, I want to give this to your school, not to your foundation, or the other way around. Foundation, a lot of them, that's what they're doing, is raising money to support the school. And so a lot of development officers will tell them, we'll put it in the foundation because we're going to get the benefit anyway. And it helps bring qualified board members onto the foundation because they see the foundation's growing and really helping the school, and they want to be a part of that. So the exempt purpose is the IRS exempt purpose. When they get created, our affiliated entities, part of that will say just to help support the school. So anything that the foundation has is to be used to support the school. Now, the foundation itself may have expenses, and they will come out of those funds as well, but their exempt purpose, the reason for being, is not for the foundation to grow bigger and bigger and bigger and become a big deal. It's for them to support the school. And the foundation can do things the university can't. An example, is anybody here in the School of Medicine? Anybody work with the Med Foundation? Okay, so here's an example that happened several years ago. We had patients coming into the kidney center. And in one particular case that stands out, it was a child coming in to have a kidney transplant. I think the kid was about 7 or 8 years old. I think it was a little boy. But anyway, coming in to have a kidney transplant. They did not live here. They lived somewhere else in the state. The parents naturally wanted to be here with the child. They, didn't want to just drop the kid off, have a transplant, and leave. So they wanted to be here with the child. But they did not have the money to pay for their hotel or to pay for their food for 2 or 3 weeks or however long the period was going to take. They didn't have money to pay their electric bill at home and still be here not working. And so the School of Medicine and the Med Foundation said, we've got to do something to help these families that come here to receive our services. And so they decided to create a fund at the Med Foundation that would allow these families to apply for funding to pay for their bills at home and their bills here while they were here with their sick child. And we couldn't do that at the university because I just told you, we're not allowed to give away money. Now, the foundation does have different parameters, and they can support the services at the school, and they are allowed to give money to something like that where we are not. So that was a prime example of a way the foundation can benefit the school by being able to pay for something the school can't pay for. So, okay. I got my notice, it's 4:30, so we'll move right along. Plant funds, these again go through our bond and debt proceeds, through our accounting area. If you have them, you'll know it, and they'll tell you what to do with them. If you don't have them, I wouldn't worry about it. So now that we've been through all of this, the other thing I'll just mention, you see on the board, they're categorized by income and purpose. So when they say, what kind of trust fund do I need? Well, where's the income come from and what's it going to be used for? That's how you know. So the question, how many types of trust funds are there? 12 and more, because you can have nuances within the 12. There might be 3 or 4 ranges. Everybody gets candy. I'd throw it at you, but I'd probably hit you with it instead of it. So A to Z, the endowments, we talked about those on the sheet just a minute ago. The expendables are there. And actually, I put A to Z, but it's really A to X, so I kind of lied. But forgive me for that. So do I have cash, budget, or both? And I'll be really, really quick on this. So generally speaking, if your unit owns the trust fund, then you have cash, okay? And these slides will be available to you, just so you know that you'll have these. So if your trust fund is owned by your school or your area, then you will own the cash, okay? And let me give you an example of how cash and budget work. You have a checkbook at home, right? How many people have a checkbook? Everybody? I hope so. You have a checkbook at home. You might get paid and put your $5,000 paycheck in the checkbook. But are you going to go out and spend it all? No, you're not, because you have a house payment, you have a car payment, you have daycare, you have food, all those things. So all those things that you want to pay are in your budget, right? Okay. That's the way it works with trust funds. Trust funds, the cash is like your checkbook. The budget is what you can spend. Okay. In some cases, it's the same thing. It just depends on the way your trust fund's set up and what you're using it for, whether your cash and your budget will be the same thing, but they don't have to be. And you can set those budgets up in the system. And I think there was a session on budgeting earlier that you can find out how to do the budgets in those. So the difference between a budget balance and a fund balance, this is a question that comes up a lot. So a fund balance is basically the money that's left in there to spend, and that includes the adjustments made for assets and liabilities, which you may or may not even see at your end, okay? Let me give you an example. So the fund balance will be adjusted by the number of cash advances you have outstanding, okay? Or they may be adjusted by the number of liabilities you have outstanding that are promises to pay that haven't been paid yet. The budget balance is just what it says it is. It's the balance of your budget. You said of my $5,000 paycheck, I'm only going to spend $2,000, but I've spent $1,500, so your budget balance might be $500. But your checkbook balance may be $1,000 because you've got things that haven't paid, your check hasn't cleared, and so forth, okay? So you kind of keep that in your head. That's the difference between a budget balance and a fund balance. The budget balance also only reflects the revenues and expenses. It doesn't have any of those adjustments for your assets and liabilities. So your answer, do I have cash, budget, or both? What's your answer? Both. You have both, right? You can have cash and budget, or you can have both. Can't have budget without cash, though. Let me just say you have to have cash in order to spend the money. So a quick question on this one. There's different ways to give you budget, and I'm going to be really quick here. So if you have questions, we can talk after. I just don't want to keep you any later than what we said. So do you have cash, budget, or both at your particular unit level? And that depends on where you are in the hierarchy of the world at your school or your unit, okay? In my case, we have one department in our unit, and our finance team controls the funding for the whole department. And so we own our cash and we have all our budget. Now, if you're in the college, how many people are in the college? Or are you in school of medicine or another large unit where you don't control your cash, for example? So your dean's office may get a pot of money, trust fund money in. Maybe it's a big pot of money for something, maybe support services. And they have 3 departments they want to give it to. So the dean's department is going to own the cash, but the departments are going to get the budget, okay? So you can't go past your budget. So the dean may have $1 million, but you may each only get $50,000, and that's all you get to spend, okay? So in that case, do you own the cash? No, your dean's department, your dean's office does, but you can spend your budget. Whether or not you get to keep that budget if you don't spend it all is up to your dean's office, because they're the ones that control the checkbook, the cash, okay? In my case, since my team is the only one there, our dean can say, yes, I want the cash to roll over to that program or not, and that's who makes that decision. Sometimes you have departments that have funds. If a donor gives money directly to a department rather than to a school, then that department will own the cash. It doesn't have to share it with anybody. Or if they gave it to the school, it would go to the dean and they'd have to share it however they determine. And then there's inter-school funds. And somebody asked me this question, I forget who it was, brought this up a little bit before the meeting, before the session started. So inter-school funds are things like, I'll pick on Gordon. So Gordon works in the provost office and he has money that's available to give to the schools. Summer school is another good example. They get a pot of money for summer school and then they divvy it out to everybody. So their department, provost office, summer school, they get the cash, but they can give the budget out to you to spend. If you don't spend it, they can take the budget back. They can also choose to give you cash. If they give you cash, then usually you get to keep it if you don't spend it. They say, okay, we're going to fund your project. Here's $1,500 and we're going to give you the cash and be done with it. And it keeps them from having to track all those little transactions for that small amount of money, but it also gives you cash in your area that you can choose to do. So you can get cash or budget from the inter-school. You'll also see inter-school when somebody says, we're having a big minority health conference and we'd like your school to give us $500. Well, sometimes, depending on what kind of funding you have, you're going to give them budget or you're going to give them cash, depending on what you have in your area, if you're a budget owner or a cash one. Terminology, this is where the ABC comes in. So associated budgets, so these budgets, they update the trust expense budget based on the revenue that you receive. And the fiscal year end balance will automatically carry forward as your new balance on 7/1 of the new year. So revenue will be available for all expenses. On the associated, it includes the balance from a prior period, your fund balance in your carry forward, okay? So if you see an associated budget, it's going to carry your fund balance amount forward. Now remember, your fund balance has been adjusted. So it's not a true just a budget. It's a budget that's been adjusted by the fund balance, okay? ABC are your automatic budget creates. This is a process that carries forward budget balance, and it shows in a budget report in your ledger. And you'll also see that this only applies to sources that are in the associated budget table. There is actually a really great slideshow out there that Nicole Sebick created when she was doing training on associated budgets and on automatic budget create. If you haven't taken that training or read through that, I suggest that you do. It can be a little complicated because with the associated budgets, you have to look at the revenue and the expense budget, where typically in most of your trust funds, you're only going to budget your expenses. This budgets your revenue and expenses, so you need to be aware. But it's a little more complicated than we can talk about in this quick session right here. Tips and tricks. So beginning balances. How do you find a beginning balance on a trust fund? Anybody use the SAS reports? Okay, you're familiar with the comprehensive report that's in the SAS reports? That's how you find your beginning balance at the beginning of the year. And then throughout the period, you're going to need to track your beginning balance, because SAS starts with that beginning balance and then it gets adjusted throughout the year. But the balance isn't going to change. The beginning balance isn't going to change. So when you're giving your report for July, you're going to have that one that came from SAS. When you give your beginning balance for November, it's going to have to be one that you calculated based on the amount that came out and the amount that's left. So you're going to have to track it on a spreadsheet or another system to track those. Okay. Yeah. Well, you can't. Connect Carolina will not track your monthly balance for you. Beginning balance for you. It'll track the first one.
I'm going to ask just a general question going back to the Connect Carolina. On the SAS report from the comprehensive fund balance, where did the original, what was the original source where that beginning balance from that first year that it started? Because one of our accounts basically has a beginning balance of 0. We actually had a fund balance when it rolled over. So
Okay.
where did that come? Where did that original balance in FY14?
So she's asking, where do the original FY14 balances come from in Connect Carolina? My understanding, and Nicole, correct me if I'm wrong, my understanding is that was the fund balance in that GL or SL at the beginning of FY14 when it went live. Now remember, back in those days, we had general ledger and subsidiary ledger. And so some of those were eliminated in the process of moving them into Connect Carolina. So if you had a balance in, say, the subsidiary ledger, it may have got rolled up into a general ledger. And so you wouldn't see the subsidiary ledger would be a 0 balance. And sometimes they shouldn't have given it a separate source in Connect Carolina, but occasionally that did happen. But if you have a question, I would suggest you call accounting services and talk with them about why that's 0, because they can go back and look. And say, Nicole, anything on that?
I just would say if you can find if you know the FRS number that it came from, you should be able to request through the Health Services Desk the record of that balance in FRS as of September 30th, and then you would be able to tie that back and you'll be able to see where that balance was first.
Did everybody hear her? Okay. All right. So program and cost coding, why are these important? So whenever you have trust funds, you may have different people using that pot of money. You want to track it using program and cost coding. Everybody does this differently, so I can't speak to how you're doing it in your area, but if for some reason you're not doing this and using those cost codes, I'm telling you it makes a huge difference in being able to go back and reconcile those funds and reconcile the bits of budget that I gave to each person in that one. Ending balance. So another thing, just as a tip and trick here, if you have cash advances out there, the system does not track the receivables for you in your basic Connect Carolina screens that you would see with your transactions and your ledgers and that kind of thing. So you need to make sure you're tracking your accounts receivable outside of Connect Carolina in a spreadsheet. Now you can look on that comprehensive balance, and if you go past the fund balance, you'll see something over there called claim on cash. If it's different, then that means there's likely a receivable or payable out there. And then if you move over a little further, a couple columns over, you'll see those receivables listed in total. And you can go down and find out where they are and go back and look and see. But they won't show up as receivables on the SAS screen or on your ledger or financial screen. So you do have to track those. Clean up balances. How do you clean up balances on a trust fund? There's 2 ways to do this. So if you have charges on a trust fund that make it go overdrawn, you can move those charges off that trust fund onto some other funding if it's allowed, if that other funding allows you to do that. The other way is to transfer funds. So let's say I have 2 gift funds. They're both to help support the school. I've overdrawn one, but the other one's sitting there. I can transfer funds over. I can also move charges over if that's easier. It just depends on the type of fund that you're using, what the purpose is for that fund, and whether it meets the same criteria for those charges to be moved over there. But those are really the two ways that you can clean up your trust funds. And at year end, you're probably doing quite a bit of that, moving charges and transferring funds. You can also transfer funds from your foundation to your school to help cover overdrafts. If you have some unrestricted funds that can come from your foundation, we do that periodically as well. Resources, I won't go through these. You can take a look. Some keywords to use when you're searching on CC Info: trust funds, budget, commitment control. For those of you that don't know, commitment control is the PeopleSoft speak for budgets. So you can see that. It's also called KK. You'll see that in some of the training literature. You'll see the KK budget or KK balance, same thing. Fund balance. And then CC Info is the best place to go to get information, find out what training's available, and really get some how to get access, all of that. So you can take a look. Those particular ones will lead you directly to the Budgeting 101, the Associated Budgets webinar that's out there. And then I mentioned there were some other papers out there too that you can use as little, I call them cheat sheets, resources for you. So thank you for your participation. Are there any questions? Anything at all? Okay. All right. Well, thank you. Please come by and get some candy before you go.